What's going on, everyone? My name is Mandeep. Welcome back to another episode. Today, I'm going to be talking about real estate news, where we can see the interest rates going from this point forward, some market stats in the valley, and a few other things like the labor market. So it's getting crazy right now. House flipping surges to new heights in Calgary, red hot real estate market. So let's check this out. I thought it was Vancouver, but apparently Calgary comes at the #1 spot for most homes flipped in the last 12 months. House flipping in Calgary is red hot right now and has surged to the highest level of any major metropolitan area in the country, according to new data from the Bank of Canada. So the latest statistics show that 6.5% of homes sold in Calgary in the metropolitan area were resold within 12 months. Prices are going to continue to go up and people are taking advantage of this situation. That's why you're seeing these crazy things happening right now. I thought Vancouver was going to be at the #1 spot, but it's obviously Calgary, as you can see from this chart right here. They just introduced a new tax in Vancouver where basically if you flip a property within the first 24 months of owning that property, any profit that you make on that is going to be taxed at 20%. So I don't think that applies to people that are flipping properties in their holding companies, but it's definitely going to apply to people that are flipping their primary residence. They have a little bit of a story here. So someone started flipping houses 20 years ago, often renovating the property before reselling them. These days, however, he says that that's not even necessary given how quickly demand and prices have risen. You can blame people and say that these are capitalists, but at the end of the day, these are people just taking advantage of the situations that have been created by the Canadian government. They did this to the markets. They printed a whole bunch of money. They gave it to people and into corporations as well. And when that money came into the hands of people, what those people did, the smart ones at least, instead of just going and buying disposable goods, what they did is they bought assets. And the people that have benefited the most in terms of making profit and money in the last couple of years after COVID are the people that put their money into real estate, stocks, and in crypto as well. So they are the ones that created this environment. The people are not the ones to blame for this situation. And also buyers are feeling the squeeze. Obviously, as prices continue to go up, interest rates are all at all-time highs. It's really hard to get approved for a mortgage. So I understand from their perspective as well. So where can interest rates go from this point forward? In this article, they're saying that history may be a guiding principle. The Fed last raised interest rates in the summer of 2023. In prior interest rate hiking cycles, the Fed began cutting rates about 8.5 months after. So I think that puts that at about right now, March, April-ish, I think it is. But a better predictor is actually this right here. This is a really cool tool. It's the cmegroup.com. The website is right at the top. You can see there. And they're predicting that by January, February, March, April, May, June, July. By July, there's a 75% chance of a rate cut. And by the end of the year, actually not even the end of the year, by November, they're predicting a 96% chance of a rate cut. And a lot of my buyers are waiting on the sidelines to purchase. Honestly, I would recommend you purchase now because I think that prices by then are going to be going up quite a bit. So this is a really good tool. Check it out from time to time. These predictions are by the market. Now, it doesn't mean that it's 100% guaranteed or anything like that, but usually it's pretty accurate. Canadian standard of living plummets lower, approaching lost a decade. This is insane. I thought that when you pay higher taxes, what ends up happening is the standard of living in your city should be going up because those taxes are used to improve the roads, the services, the healthcare. It goes towards co-op schools and all that kind of stuff. But not in Canada. The rate of the taxes in Canada continue to rise, but the standard of living is going down. And what else do we have here? So I just want to show you guys some stats as well, what's going on in the market. So I just recently purchased a condo in Abbotsford, and I think that I timed the market pretty good. I bought it a couple months ago. This indicator lets you know if you're in a seller's market or a buyer's market. You shouldn't be buying up here. Should not be buying up here. You should be buying down here. And I purchased right here, right around this area. Anything above 20% is a seller's market. Anything below 20% is a balanced market. And anything below, I think it is 11%, is an extreme buyer's market. And it rarely reaches that area. It hasn't reached that area since a very, very long time ago. It looks like the last time it was in that area, as you can see, it doesn't go that far down very often. February of 2015, that's insane. So the last time it was an extreme buyer's market was a very, very long time. Whenever you find yourself in these areas right here, this is an amazing time to be accumulating assets. And this is an amazing time to be selling when you're way up here at like 62%, 75%, 210%. A lot of people are starting to say that we're not going to be in a recession. And what's going to end up happening is that the commercial real estate market is going to get hit really hard. So I wanted to see which banks are exposed to the most real estate exposure, commercial real estate exposure. So you have Bank OZK, you have IBC, Valley National Bank Corp, CBV, Financial Corp. They're saying that these markets are too exposed to the commercial real estate market, and that's the one that's going to be affected the most in this recession. Houses are not going to go down in price. I don't know if I believe that or not, because if people don't have money to spend on homes, then who's going to buy the homes? And in the next article, I was actually going to look at, there was another article that I was going to look at, and basically it was talking about how many people in America are delinquent on their MasterCard bills. And it was a high amount of people. And the debt is going through the roof. So basically, if there's a lot of debt, people don't have money to spend on disposable goods. They don't have enough disposable income to spend on things like Rolexes, Nikes, luxury cars. So what ends up happening is those companies like Nike or Amazon or whatever the case may be start laying off people. And when they start laying off people, it's kind of like a downward spiral. What ends up happening is we go into recession, people are not spending their money. And then what the government has to do is they have to step in and inject the economy with stimulus. And basically that means they're going to turn on the printers again. They're going to bring down the interest rates. When they do that, it's easy to get finance for homes, and usually that's the best time to be buying real estate. So actually, let's just look at the labor markets. What are the labor markets actually doing right now? So the blue line is the unemployment rate in America. The red line that you're looking at is the moving average, the 20-month moving average. And usually, as you can see, whenever that blue line crosses above the red line, it accelerates very quickly and it reaches an all-time high. So unemployment was at 15% in 2009. 2009 was when we had one of the biggest recessions since 1929. And usually that's the case going back in all these other cycles as well. So this is the big dot-com bubble that burst, and it took from after the blue line crossed above the 20-month moving average, it took 30 months for the unemployment rate to peak out and then start dropping again. And it was 2003 where it peaked out. But I wonder where they actually started calling it a recession. I'm not sure exactly. It doesn't show on this chart. But the question is, so we are already above that simple moving average, the 20-month moving average. How long is it going to take for this to peak out? 28 months, 20 months? What do you think? If it's 20 months, then the peak of unemployment will land somewhere in July of 2025. Let's see what happens. So that's the episode for today. Thank you for joining. Make sure you hit the subscribe and like button, and see you guys in the next episode.